Hey everyone, welcome back to my channel. It's Nasdaq with Arshia. Today we're going to be talking about what is happening with skills. But before we begin, I'm going to be going over our boring disclaimer first. I'm not a financial advisor and I highly suggest you do your own due diligence and research before taking part in any investment scheme. Woo! Let's get started. So Skills Inc. So at one point, we all know that this stock was at $43.72. Now it has plummeted just under $19 a share. But why has this happened? And we'll also be discussing why I think that this is still a good stock. So firstly, if we look at their revenue, their analyst expectations were $72.2 to $79.6 million, but the Skills Outlook actually gave the guidance of $80 million. So it guided Q1 revenue above estimates, and that's really good. Even though they are having volatility, I think that it is worth it. And I'll tell you why. So first, if you guys don't know what Skills is, my new viewers or anyone out here trying to invest in Skills is a mobile gaming platform that provides app developers with an audience and an opportunity to monetize their games according to Seeking Alpha. However, unlike other platforms, Skills does not rely on strategies like pay to win or advertisements to monetize their users. Instead, they allow users to make bets on contests and take a 14% cut of the entry fees, with the game developer taking the rest. In my opinion, that's really smart because standard mobile gaming platforms just do pay to win. Like if you go on Android or Apple, it's always pay to win, pay for this app, pay for this feature. But actually, they don't do pay to win, they give bets, which is extremely smart. And Skills is able to generate very strong gross margins as a result of not having to actually develop the games itself. And this has allowed the company to aggressively reinvest in marketing in order to grow its revenue. Although not currently profitable because of down reasons, its structure allows it to have a very high profit and cash flow potential. So why is this stock down though? Why? What is happening with this stock? So basically what happened is that they're recently getting the rise in bond yields. The main reason for the drop in the growth stock can be attributed to the rise in bond yields. And there was a lot of talk about the economy overheating, and I also made a video about that. You can check it in the iCards above. As if we would see dangerous levels of inflation in a developed country that's been struggling to meet its 2% inflation target for years prior to COVID. But thankfully, the Federal Reserve has made it very clear that inflation will not be an issue. But they also announced an NFL partnership and with many other companies, so I still think it's solid. And it has a neutral rating on Seeking Alpha because it's still trading at a premium to its peers. And also, Wolfpack recently gave a short selling report on this stock. So as most of you are aware, Wolfpack Research hit Skills with a short report recently. However, we found the report to be misleading and self-serving, and will highlight why. But first, we will take a look at some of the valid concerns that were raised. So, as we mentioned in our previous article, this is Seeking Alpha talking here. One of the risks associated with Skills is the fact that the majority of the revenue is derived from 3 games, just 3. I'm going to highlight that because that's really important. Although not ideal, it means that the top 3 games are significantly better than the rest. And talking about the flaws in the short seller report, near the beginning of the article, the report compared its valuation once it became public to its private equity valuation from the year before. There are 2 problems with this comparison. First problem is that Skills saw significant growth over that year. This means that the company being valued in 2020 was already a different company than it was in 2019. We're going to highlight that in green because that's super important. Again. And the second issue we have is that private equity valuations are more conservative than public equity valuations. This is mainly because public companies are highly liquid, whereas private companies are highly illiquid. Thus, private equity investors demand a lower multiple because they can't offload shares by just clicking a button. So that's really, really wrong in the report. And those are the two main reasons why it's been plummeting. One, because of the bond yield rise, and two, because of the flaws in the short seller report that was given to us by our Wolfpack research. But I still think that it is a good company because their earnings and sales are 30.13, which is really good. Their income statement, their gross profit is $270.83 million. The revenue is $230.12 million. Of course, their income and EBITDA right now is a negative because they're tanking right now. The stock is tanking. The company's kind of tanking. But that will fix if we can handle and stomach the volatility. So we just need to hang and hold on there. Otherwise, we'll be kicking ourselves in the shins for not. Also, the company's market cap is right around $7.19 billion, which is like a pretty high valuation for companies. So I feel that is a really good stock and that we should keep going and keep holding on to it. For me, I'm going to buy some more and more. But thank you guys for watching this video. I hope you enjoyed this video. And if you liked or enjoyed this video, please give a like, comment, and subscribe. See you in the next video.